Welcome to This Explainer. Today, we're unpacking the absolutely massive volatility shaking up the 2026 gold market. We're literally watching a high-stakes tug-of-war play out right in front of us, with opposing global forces just battling it out for control of the precious metals price. Let's jump right in and find out what's really driving these wild swings. Okay, let's start with this staggering number, minus 19%. Gold has suddenly plummeted roughly 19%, right off its January record peak of $15,598 an ounce. I mean, that is a massive haircut for an asset that's traditionally viewed as the ultimate stable store of value, right? Which brings us to Section 1, the Great Gold Plunge, a massive market reversal. After that spectacular, record-breaking rally we saw earlier in the year, prices had just crashed down to a yearly low of $4,366. It essentially caps off this brutal multi-week slide where technical support levels completely shattered and momentum decisively pointed downward. So, what exactly triggered this aggressive sell-off? That takes us to Section 2, the Fed and the dollar. Heavy macro headwinds. To understand the crash, we really have to look straight at non-farm payrolls. You probably already know NFP is the ultimate barometer for the strength of the American labor market, but right now, it's pretty much dictating everything. And here is the absolute shock to the system. The U.S. economy added a whopping 172,000 jobs in May. That is more than double the 85,000 jobs experts had actually predicted. It's a total blowout number, keeping the unemployment rate sitting steady at 4.3%. But, as we know with financial markets, good economic news is very often bad news for certain assets. Because, you see, this incredibly hot labor market didn't just happen in a vacuum. It collided with sticky 3.8% CPI inflation, which, remember, is nearly double the Fed's target. This whole combo sent the US dollar index surging right past the 100 mark, and the 10-year Treasury yield spiking up to 4.53%. For zero-yield assets like gold, this exact combination is pure kryptonite. The opportunity cost of holding gold shoots up, and it just drags the price right down with it. Looking at it objectively, this incredibly strong data gives the newly minted Fed chair, Kevin Warsh, the firm grounding he needs to keep interest rates high. And this is happening even as President Trump publicly presses for rate cuts. Because inflation remains a real threat and the jobs market is looking so robust, expectations for any near-term rate cut have basically evaporated. That's putting immense downward pressure on gold. Moving on to Section 3, the central bank safety net. This structural floor. Now, while traders are out there selling paper gold based on interest rates, central banks are literally backing up the physical truck. They aggressively acquired an incredible 244 tons of gold in just the first quarter of 2026 alone. That is well above the 5-year average, heavily led by countries like China, India, and Poland. Actually, if we zoom out, total global demand hit a record 1,231 tons in that exact same quarter. What this does is create a really deep structural bid in the market. Think of it like a massive sponge that just keeps absorbing the selling pressure every single time the price dips. It's the fundamental reason why the bottom hasn't completely fallen out of the market. As institutions like UBS point out, central banks aren't doing this to flip a quick, short-term profit. They're buying gold specifically because it carries zero counterparty risk, making it a true strategic diversifier. In a world where global architectures are shifting fast, they want a neutral asset, one that doesn't rely on another government's promises. This is a massive long-term structural shift in demand. Let's explore that broader context in Section 4, geopolitics and global debt, profound anxieties. Safe haven demand remains highly elevated right now for a few key reasons. A recent U.S.-brokered ceasefire in the Middle East was flat-out rejected by Hezbollah, and meanwhile, U.S.-Iran talks are currently stalled, keeping regional tensions extremely high. On top of that, persistent high budget deficits are making investors seriously question the long-term sustainability of government bonds. Naturally, that's driving them right back toward gold as a tangible, non-issuer-dependent asset. And here is our ultimate deadlock perfectly visualized. On one side, you've got these bearish economic forces, hot jobs, strong US dollar, and high real yields actively dragging prices down. On the flip side, bullish structural forces like massive central bank buying, geopolitical risk, and global debt fears are pushing right back up. It completely explains why gold has been so incredibly volatile lately, yet strangely supported at the exact same time. Which brings us to our final part, Section 5, what happens next? Breaking the tie. Right now, the entire financial world is collectively holding its breath for one specific data point: Wednesday's U.S. Consumer Price Index report. This upcoming inflation reading is going to directly impact the Federal Reserve's next move on interest rates, essentially deciding which side of our tug-of-war finally gets the upper hand. Based on how that inflation data actually prints, analysts have mapped out three clear scenarios. The bearish base case, favored at 45%, is a hot CPI print that shatters support and sends gold lower. The second scenario, sitting at 35%, is an inline print that just keeps gold whipsawing in its current frustrating range. And then the bullish case, at 20%, really relies on a surprisingly cool CPI report or maybe a sudden Middle East escalation to spark a massive relief rally. For anyone tracking this market closely, $4,370 is your critical line in the sand. That is the most vital support shelf holding things up right now. If the price decisively loses that level on a daily close, well, the momentum could quickly carry it much, much lower, potentially dropping down to $4,200 or even $4,100. So as we watch these macroeconomic heavyweights clash in real time, which underlying force do you think will ultimately win the tug of war? Is the Fed's battle against inflation going to crush the gold price? Or will central bank buying and global instability end up providing the ultimate safety net? Thanks for joining me for this explainer. Make sure you keep a close eye on the data this week, manage your risk, and I will catch you next time.